Costco just beat Wall Street's expectations again. Revenue surged to nearly $70 billion. Profits beat analyst consensus across the board. But the stock slipped. Investors pulled back, even as the numbers flashed green. For a moment, nearly $500 billion in market value looked exposed. Picture the shelves, full, humming. But the floor beneath them suddenly unstable. The company's grip on its own future suddenly in question. No one inside Costco is saying it out loud. But the threat is real, and it's growing. This isn't a story about missing targets. It's about what happens when success itself becomes a liability. Costco's price-to-earnings ratio is now near 50, almost double the sector average. The market is betting on perfection. But perfection is fragile. One misstep, and the entire valuation could unravel. The pressure is silent but absolute. Every executive knows there's no room for error. The higher the climb, the steeper the drop. The numbers are clear. Fiscal second quarter, revenue hit $69.6 billion. Earnings per share reached $4.58. Comparable sales jumped 7.4%. Digital sales soared 22.6%. On paper, Costco is untouchable, but these numbers cut both ways. Each record set raises the stakes and the risk of a sudden reversal. The stock closed at $998.10, barely changed, then slipped in pre-market trading. Investors aren't celebrating. They're bracing for something they can't quite see. The disconnect is stark. Operational strength, but market hesitation. The question is no longer how much can Costco grow, but how long can it sustain the illusion of invulnerability? Here's what's actually at stake. Costco's business model depends on relentless efficiency. Margins are razor thin. Membership fees and scale keep the engine running. But now, two forces threaten that engine. First, tariffs. Any escalation could hit Costco's cost structure instantly. The company's global supply chain is exposed to sudden shocks, trade disputes, regulatory changes, or currency swings. Second, valuation. At a price-to-earnings ratio near 50, even a small earnings miss could trigger a cascade of selling. The company is trapped between operational risk and market expectation. The room for error is vanishing. Every quarter, the stakes rise. Leadership turnover adds another layer of tension. Ron Vakris took over as CEO in January 2024. Gary Millerchip stepped in as CFO 2 months later. Both inherited a machine running at full speed, but with no margin for miscalculation. Russ Miller, the veteran COO for US and Mexico, retired in February 2026. His successor, CapitalRifts, has stepped into a system where every decision is magnified by the stock's sky-high valuation. The margin for error is shrinking. Each new executive inherits not just operational responsibility, but the burden of market expectation. The pressure is cumulative. For this team, one wrong move could trigger a chain reaction. Costco's core mechanism is simple: deliver volume, extract efficiency, and keep costs lower than anyone else. Membership fees provide a buffer, but only if growth continues. The company's scale lets it negotiate with suppliers, but tariffs and global shocks can erase those advantages overnight. Investors know this. That's why even after a blowout quarter, the stock barely moved. The market is pricing in not just growth, but invulnerability. That's a bet no retailer can guarantee. The model works until it doesn't. If membership renewals slow, or if cost inflation outpaces efficiency gains, the entire structure is at risk. The real risk isn't in the numbers. It's in the expectations those numbers create. When a company trades at a price-to-earnings ratio near 50, every quarter becomes a referendum on the future. If digital sales slow, or tariffs bite, or membership growth stalls, the correction will be swift. There's no cushion. The higher the valuation, the harder the fall. The market's demand for flawless execution turns every minor setback into a potential crisis. The company's operational discipline becomes a double-edged sword, admired but unforgiving. The inflection point is already visible. As soon as earnings hit, the stock dipped. Not because of what Costco did, but because of what it might not be able to do next. Investors are signaling the bar is now impossibly high. Any sign of weakness, operational, geopolitical, or competitive, could trigger a rapid loss of confidence. For executives, This means every operational decision is now a capital allocation decision. There's no separation between the warehouse floor and the trading floor. The feedback loop is immediate. A missed target, a supply chain hiccup, or a policy shift can erase billions in value overnight. This matters far beyond Costco. When markets reward perfection, they punish anything less. High valuations create invisible constraints. They force companies to chase growth at any cost or risk collapse. Governance becomes reactive. Strategy narrows. The illusion of control fades. For Costco, the threat isn't a missed quarter, it's the slow erosion of room to maneuver. The company's legendary discipline is now a source of vulnerability. Every strength becomes a potential weakness under the weight of expectation. The lesson is stark. In capital markets, success can become its own trap. When expectations detach from reality, even flawless execution isn't enough. The risk isn't just volatility, it's the loss of agency. For Costco's leadership, the next mistake, however small, won't just cost money, it could cost control. The market's demand for certainty leaves no margin for uncertainty, and in that gap, power quietly slips away. CapitalRifts, where money breaks.